Hello, so I'm sitting in a retirement community in beautiful Milwaukee, Wisconsin, and wanted to take just a moment to talk about another question that comes up quite a bit for us here at myLifeSite, and that is the question about tax deductions on fees at a retirement community. So you may have heard this before that particularly as it relates to a continuing care retirement community or a life plan community as it's sometimes called, that a tax deduction may be available on some portion of the entry fee as well as potentially some portion of the monthly fee. So there's a lot of detail that goes into this, but I'll try to give you just a quick high-level overview. First, it's important to understand how the medical expense tax deduction works. In general, anyone can, whether you live in a retirement community or not, if your medical expenses over the course of a year exceed 7.5% of your adjusted gross income, then you can deduct that difference. So, add up all of your expenses, whatever that number comes to, the amount that is above and beyond 7.5% of your adjusted gross income can be deducted as a medical expense tax deduction. So that's the tax deduction that often can apply at a CCRC, a continuing care retirement community. Sometimes people think it has to do with whether the community is not for profit, and that really doesn't have anything to do with this particular deduction. That applies really more at the community level, from the organizational standpoint, and whether they have to pay taxes on certain things and so forth. But when you hear about fees, entry fees and monthly fees being deductible, we're talking about a medical expense tax deduction, which essentially in this case can be used even when you're living independently, even when, in other words, you're not receiving care. So you move into the retirement community, you're still independent, maybe still very active, you're not receiving long-term care or nursing care or anything like that. You can still take the deduction, and that's what's unique about this. And the reason why is because some CCRCs, not all of them, it depends on the type of residency contract. So be sure to check out our website to learn more about that. But depending on the type of contract, essentially what's happening is some portion of your monthly fee and some portion of that entry fee may be used towards future medical expenses. In other words, it works a little bit like an insurance company where everybody that moves in, that lives there, there's a little bit coming out to cover the cost of medical expenses for the resident population in that community. So that's effectively what's happening. You can really think of it as a prepaid medical expense tax deduction. So when you think about it, the important thing here is that, as I said earlier, you can take all of your medical expenses during the course of a year and add those up. But now the difference is when you're living in the retirement community, you can add on top of that or include with that whatever that portion is from your monthly fee and your entry fee that's been designated as that prepaid medical expense. And there's a formula to that. So the retirement community generally sends out a letter every year to their residents that said, based on our budget last year and expenditures on healthcare and everything, here's sort of what that formula is. And you take that to your CPA, your tax advisor. And so essentially you're just adding an additional amount on top of all of your other medical expenses during the year, whatever those were. So let me just finish by saying that this is not tax advice or financial advice. You need to talk with your tax advisor and financial professional before making any decisions about anything related to tax deductions at a retirement community.